My name is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and recent developments in energy markets. So on the call with me today, we've got Will Hares here in London. He's working from home today. If you're not in London, there's massive train strikes going on, so it's a bit of a faff to get around at the moment. And we've got Fernando Valle joining us from the New York metro area. So hopefully it's going to be a very fun conversation. Normally we've got a few other colleagues who join us, but they're still off enjoying their year-end holidays. So one thing that I want to start with today is a little bit of a different corner. We often have a lot of commodity and oil and gas focus on this call, but there's been a really interesting development in the polysilicon market over the last few weeks and months here. If you don't follow polysilicon, it is essentially the key ingredient for the solar industry. It's what all the modules, aside from a few made by First Solar that are cadmium telluride, but most of them are made from polysilicon as the key input ingredient for making modules. And the price of polysilicon at the start of December was about $33 a kilogram. And today, the latest assessment from PV Insights came out and pegged it at $17.5 per kilogram. So we're talking about a nearly 50% price drop in a very short order of time here. We've been talking about this risk for quite a bit if you followed our solar franchise. The real impetus in our view for why we're seeing some price erosion is because there's just an incredible amount of new supply coming online this year. We've seen polysilicon capacity, if you look at the amount that's under construction plus the amount that's announced by companies that they're intending to build, we will more than double the amount of productive capacity if it all comes online. So there's no cure for high prices like high prices. And if you don't know the time series, polysilicon had been coming down and down for years. And then around the pandemic, kind of aligned with a lot of other commodities, it really took off. And when it was elevated, it was up almost 4 or 5x versus the pre-pandemic levels. And we're starting to see some of that come back off. Now, of course, the decline in polysilicon prices is quite bad news for the polysilicon producers. A company like Wacker Chemie in Germany, OCI in Korea. There are no U.S. listed kind of pure play polysilicon type players, but we had flagged this as a risk, and we really think that they're going to have difficulty maintaining margin in the face of something like this. They do have other divisions. They're essentially chemical players to some extent, and they're going to have to rely on some of their other output to help with this fall off. But in recent years, a big part of their narrative and margin contribution was coming from this run up in polysilicon prices. So they've certainly got some headwinds. On the flip side, if you look at the module makers, the decrease in polysilicon is a good news story. It's basically lower input cost that could potentially help increase margin, particularly if module prices are a tad sticky. I would note that a lot of the players in the industry have been locking in module prices, so they're seeing module prices maybe remain elevated while input costs go down. So potential positive story on the narrative for some of the both module makers or perhaps some of the equipment installers as well. So a very interesting development in the solar industry. And also, I'll just quickly mention on the wind side of the equation too, steel prices are also down about 50% from a peak that they hit right after Russia invaded Ukraine. And we think that the wind folks could also see some margin uplift from lower input costs here in 2023. So on both the wind and solar side, we're seeing a bit of deflation type of story into the conversation. And that's probably a good segue to flip over to oil. And
well, Rob, if you allow me, I'll play the moderator on this one since it's not our type. But I was just going to ask first: is there a marginal supplier in either the polysilicon side, and where would they be? And then second, how do you see that translating into higher into demand, to demand side of the equation for both PV and then wind installation, or do you think there's no elasticity? Or
Yeah, so it's a great question. So from a supply perspective, especially if we are in an oversupplied market, we could very much end up where the variable cost of operations kind of set the floor price. And when you think about the marginal producers, the ones that are going to have the highest that are going to be highest on the cost curve would be your non-China producers. So a lot of the cheap supply is coming from China. So Wacker Chemie, German producer, OCI is based in South Korea. These are the kind of companies that are going to be at the high end of the cost curve, and their costs are maybe $10 per kilogram, this kind of range. So prices could certainly go lower from where we are today if you've got a oversupply situation and you're kind of thinking about, well, what's the variable cost of production to kind of set that floor in the short run. In terms of demand, I think it is relatively inelastic. If you look at solar demand growth, it is just an unfathomable growth story. I mean, we grew globally about 50% last year. I think the specific number is 47%, and that could change based on kind of the final 4Q numbers, but very tremendous demand growth. And so all things being equal, if polysilicon prices end up maintaining their retreat, and you have that translate into lower module prices on the margin, I suppose that's a positive for demand growth. We do see demand kind of continuing to grow at double-digit pace, maybe 20-30% is not out of the picture for 2023, and maybe there's upside on the demand piece if the polysilicon and ultimately price to consumer is lower. Yeah. Okay. So look, let's flip it over to oil a little bit. So we've got this deflation narrative that I think could be coming through on both the wind and solar side. Oil has really started the year with a whimper, but I mean, we've been on a 6-month trend here, more or less, in the oil world where prices have been going down or sideways. And so I know that both of you guys see a pretty constructive set of fundamentals for the oil market, but certainly not seeing that translate into where Brent or WTI has been as of late. So Fernando, let's kick it over to you first. We've had a few weeks off. Prices have been pretty tepid. What do you make of it? What's going on with the latest indicators in the oil market?
yeah, I think it's playing out a little bit as Will and I had expected. That the short term, there was a lot of headwinds from the demand side of the equation as we curtail energy consumption in Europe to preserve inventories for the winter, as we see higher interest rates globally impacting consumer demand and consumer confidence, and then China's COVID zero policy that was then limiting the demand out of China itself. Obviously, largest oil importer in the world, that's going to have a significant impact on oil consumption. So that's been playing out. And in fact, I think that the dip in oil prices has not been nearly as much as we thought it could have been to date. And there are a few reasons for that. One is Europe has done a great job in filling its inventories. We've had a mix of mild and cold weather, but we haven't had a continuously cold winter season to date. I'll say that we are around 35 to 40% through the heating season. So, a lot of the danger has passed us now. And then we had the biggest news of all, which was China reversing very abruptly on its COVID zero policy, which, originally was supposed to end in February, but then it hit all at once in December as the unrest was growing in China. Now, the impact at first has been very negative, and there are people saying there's been normalization of demand in China. But if you look at just public transport ridership, we're still 30%, 20% of the norm, seasonal norms, and we are seeing the Omicron virus ripped through China, having significant impacts, and people are still reticent of going back, even though they don't have the mandates anymore. They don't want to expose themselves to the virus yet. That could change after the Lunar New Year, and as this wave passes, as we've learned in the western side of the world, goes on peaks and valleys, and there is a seasonality to the virus. And as this first wave winds down, that's when we see the potential for demand to recover and then be a tailwind for oil and gas prices.
Yeah, Will, let's get your perspective. I know, you know, Europe has probably, and the U.S. went through what China is currently going through with kind of dealing with some of the real impacts of having COVID go through their population. But you know, what do you make of potential demand recovery? And I think to just also frame it enough, I mean, we've revisited this topic so often, but are you concerned about supply shortfalls in the face of that demand recovery, and is industry investing enough to get that supply to market?
Yeah, so I think I would just echo what Fernando is saying. For 2023, we remain pretty bullish, particularly when we're looking at where Brent is right now. It's sunk below $80 a barrel. I think WTI actually crested below 75 as well. And so with the factors that Fernando mentioned, we think that there's good chance for it climbing early in the year with that Chinese reopening. As far as underinvestment goes, I can say that the European majors are remaining highly disciplined, particularly on their conventional and traditional oil and gas investments. Even in the face of significantly higher oil prices last year, we expect highly disciplined budgets to come out early this year, with one exception. We continue to expect an increasing share of that green Capex, which we saw last year. We actually saw a record percentage share of Capex allocated to transition businesses from the group. And in particular, I would highlight BP, including its Archaea biogas deal, which closed before the end of the year. They actually accounted for over a third of their Capex was allocated towards transition businesses. We expected to land somewhere between 20 and 25% this year. That's still very high, and we expect this to continue to beat expectations. One of our predictions from last year was that the group would add more than 5 gigawatts, add or acquire more than 5 gigawatts net of operating renewable power capacity. And then the group exceeded that by the end of 3Q. So I think this sort of tracks well with what you were saying on both wind and solar, Rob, is that the growth here is storming ahead of expectations, and I also think that the conditions and backdrop is sort of priming one of the members of the European energy major peer group to make a big splash on a probably a renewable power company within the next 1 or 2 years to really supercharge that their footprint in the power space.
Thanks, Will. I love this transatlantic divide that we keep revisiting in part of our discussions here. But I want to echo a point you just raised. Our colleagues at Bloomberg News, and we can share this in our follow-up via email or over IB, put out a really interesting chart yesterday that showed the issuance of debt by two groups. They looked at the fossil fuel industry, and they also looked at any debt instrument that was considered a green bond. And last year, for the first time, we saw green debt issuance exceed that of the fossil fuel industry. And so it seems like we hit a milestone last year. And I just wonder if, I know that the Capex that the oil majors and other folks in the industry are spending is a bit of a different paradigm, but I think it is related. And so, Fernando, I know you're a bit more skeptical on the idea of all of this sort of green capex being such a focus for the oil industry, but it's certainly not zero anymore in the U.S. And so, kind of how are the U.S. Players looking at this? Do you think they're still going to be dismissive, or are we going to see them step up more in 2023 on this front as well?
Well, I think they did step up in 2022, even if you look at, for example, Chevron buying Renewable Energy Group, um, Exxon announcing several partnerships in CCS and projects in CCS, concrete projects in CCS, and then um, renewable diesel in Sarnia in Canada and other renewable projects. So there's been movement. I just don't see them going into renewable power. And they've been very clear that they don't believe in renewable power. And then in this side of the Atlantic, in Will's native candidates, they've also gone backwards, on that front. Suncorp sold all their wind and solar assets last year to focus on advanced biofuels and carbon capture. I think the incentives that were given towards carbon capture and hydrogen only push them further towards that path as opposed to renewable power. And I mean, there are several reasons for that make it different than in the UK or Europe. I mean, for one, Shell was literally sued and lost in Holland about their carbon emissions. That won't happen here with the oil majors. Second, there's been a lot more push from European regulators into the emissions front than in the U.S. side. And third, the U.S. gave those incentives to hydrogen and carbon capture in the Inflation Reduction Act, which so far are unmatched in Europe. There's talk of Europe trying to catch up to that. So all of those combine to say they will do renewables, but not renewable power. I don't expect that they will have solar and wind farms and move towards a utility type return. It's just not compatible with their capital structure and their dividends. And we saw that acknowledged essentially through dividend cuts at BP and Shell that more reflect the lower embedded returns on capital for renewables. And that's not me saying, that's Equinor, that's BP. They've all, Woodside Energy, they've all put in that the expected return on those projects is significantly lower than oil and gas. Woodside, for example, expects an IRR of 10% on new energy versus 15% on oil. So it's a 50% change, and that's they're investing in hydrogen, which is still a very uncertain market. Just as an example, I think Equinor expected 7 to 8% return on capital, and BP was similar on their renewable power. That won't pay Exxon's dividend. Essentially, that's the big divide there.
Will, I want to probe a little bit there with you as well. There is a pretty big focus on renewable power, but I believe a number of the European players are also quite active on the biofuel front. And when you think about some of the hard to decarbonize sectors, shipping or aviation, perhaps, it's not clear that there are any other leading pathways other than perhaps some type of advanced biofuel. But how are the European companies thinking about like that piece of the portfolio?
Yeah, I mean, all of the European majors are active to a certain extent in biofuels. All are active in very early stage hydrogen. I think there's a lot of excitement that we're seeing from management teams around the potential for a larger scale market to establish deep into the next decade. But yeah, I think to Fernando's point, the European majors are indeed flagging lower project IRRs for their renewable businesses. I think the difference here between them and the Americans is that there is a major divergence in views of how global oil demand will develop over the next 10 to 20 years. So you can see most of the European majors think that peak oil demand is somewhere around 2030 to 2035 maybe, and I believe Exxon is probably more in line with OPEC for instance on how the oil market will play out, and we're seeing that reflected in their upstream strategies, which is pretty noticeable. So not only have we seen major divestments from legacy oil assets in the portfolio, from BP, Shell, Equinor, all of them, but we're also seeing a de-emphasis on that upstream investment. So all of the European majors, with the exception of Equinor and Total, have already hit peak oil production, and they're in sort of managed decline from now on. Equinor and Total will also hit peak oil production within the next 2 years, 2 to 3 years, and then it's managed decline from then on. And you compare this with Exxon, which expects to hit a million barrels a day, I think up from around 300,000 right now, by the end of the decade, just from Guyana. Fernando, correct me if I'm wrong there, but there's major growth being plotted, oil growth by the U.S. majors, and I think that is a massive differentiator in strategy from the Europeans.
No, I totally agree.
Anything to add on Exxon?
I totally agree. I mean, Guyana's the biggest one on the growth front, but the Permian up until now has been that leading car for Exxon and for Chevron. Both are expecting to go over 1 million barrels a day by 2026, 2027. And I think that just reemphasizes our point that the supply picture has a real issue, and it starts to show probably in the second half of this year. Barring a very, very deep recession globally that curtails demand. But perhaps the biggest issue is that U.S. shale production just hasn't kept up with expectations, and then OPEC has cut back, and then Sally's not here to comment a lot on this, but we've talked about it before that we just don't think that OPEC has all that much spare capacity to meet that delta in the oil market. So what happens when U.S. shale, current expectations from the EIA in the U.S. are growth of 630,000 barrels a day. That's unlikely, I think, at current prices and current inflation, for them to hit that level. Probably talking more in the 200 to 300,000 barrels a day. And then, if OPEC actually does cut back 1 million barrels a day, and we see disappointment in my native Brazil, which we can talk about later, but it's all gearing up towards that way. Who makes up that delta if China consumption goes up to what it used to be, pre-COVID zero, which is another 600 to 700,000 barrels a day? If Europe stops curtailing energy, which is another 300 to 400,000 barrels a day of demand, those questions are what leads us to see a gap in the second half of the year. And just a reminder, also, the SPR releases from the U.S. are tapering down, and they could eventually become a source of demand as they try to refill it.
Yeah, I want to follow back up on some of those geopolitical concerns that both of you just raised. So I'm particularly curious, before we come to Brazil, let's talk about Russia first. With the European oil majors exiting Russia, I am curious to hear your thoughts on, can Russia continue to meet the existing supply it puts on the market without the expertise of some of the Western oil majors being active in the country? And are you worried about supply shortfalls from Russia in particular because of sanctions and other factors as we look into 2H? And is Russia really the entity to keep an eye on, I guess? And we'll come to you first, Will.
Yeah, so I would just say it's not just technical expertise that's lost from the exodus of Western majors from Russia. It's capital, first and foremost. It's also technical, but it's also equipment as well. So we've seen a lot of the U.S. service providers, following up the announcements from BP and Shell and others saying that they were restricting their services and pulling their workers as well. So what I think this does is it contributes to a sort of slow, gradual erosion of production capacity from Russia, which will absolutely exacerbate the supply scenario. Maybe not early this year, but later and into next year. And as far as some of the sanctions on Russia, we haven't seen that much impact yet. The $60 barrel price cap that was enacted by Europe was sufficiently high to reflect existing discount levels for Urals, and we also immediately saw widespread reports of circumvention of the sanctions via ship-to-ship transfers and so much of and that sort of thing. So I think from a sanctions impact, limited on the actual trading and volumes, but absolutely from a longer term ability for Russia to continue producing at the 10 million barrel a day plus level. We will definitely see pressure on that.
Yeah, Fernando, anything to add there on the Russia context?
Yeah, I'll be a little pedantic and say I think I agree mostly with what Will said. The one caveat I think is just semantics. I think the sanctions did have an impact, but it was mostly the self-sanctions and then the weather. Because Europe went out and bought all the LNG that it could from Africa, Asia, US, you name it, and then the weather has cooperated. Some of the revenues that Russia was expecting, holding Europe ransom in a cold winter, just haven't materialized, and they haven't materialized in price, and they haven't materialized in volumes. And then the other part is there has been it's kind of on a macroeconomics doesn't make sense, but there's been significant inflation in Russia, even though the ruble has actually appreciated, and that's because there's just the way that they have worked out their balance of payments, they created artificial demand for the ruble, but because there's been a lack of supply of goods to Russia because of sanctions, there's been significant domestic inflation. And typically in EM we associate currency devaluation with inflation, and this has been kind of the reverse. So long story to say, I agree with Will. I think that there's the lack of capital hurt them more than anything else, and they are certainly something to watch. I mean, Russia itself has warned that it will go below 10 million barrels a day of production this year rather, and they could fall even farther. I'll just remind everyone, most of Russia's production is Western Siberia. It's conventional. It's not theoretically that hard to extract, but it is capital intensive. You're constantly drilling, and has a high natural gas content, which makes them the largest exporter of pipe gas in the world, especially to Europe. So it requires significant capital uplift to continue that production.
Well, one little caveat there: Russia is no longer the largest pipe gas exporter in the world to Europe.
Yes,
that's Norway.
Good point.
Cool. All right, for everyone listening, we've got at least 1.5 more topics we want to try to hit today. So if you got to drop off because you got a constraint at the half-hour mark, we'll get the replay out afterwards. But just quickly before we touch on the very interesting LNG narrative, Fernando, I want to come to you on Brazil. We've had a change of leadership. In fact, just the other day I saw a picture of Brazil's former leader eating at a KFC in Orlando, of all places. Very, very interesting photograph. But what does the change in leadership mean for expectations around oil supply out of Brazil, in your view?
Well, first and foremost, Orlando is little Brazil. Even my wife, who's from Orlando, didn't know that, but we occupy everything up and around the Walt Disney World parks. But I think it has significant changes. They have announced they've nominated the president for Petrobras, He's a politician. He has, however, a long history in oil, despite being a politician, which allows him, under Brazil's state-owned enterprise law that was enacted under Bolsonaro, to be appointed. Likely he passes muster on that front. Um, but he wants to change, the dividend policy, which will mean a huge change in the cost of equity for Petrobras. He wants to keep more cash in the company or put it back into investments. And then the question is not what that investments are bad, because theoretically you do want to be investing in Brazil's pre-salt fields. They are some of the best in the world, if not the best right now, in both size and cost of supply. But he wants to invest in refineries. And my favorite anecdote of the former Lula and Dilma years is that Brazil invested upwards of $30 billion in refineries, 5 refineries to be exact, and he completed half a refinery for a total of 115,000 barrels a day, away from any and all oil production in Brazil. So it has been a huge money drag for the company, and reviving these failed refinery business. The two more that wanted to be built are in the northeast of Brazil. There's very little production of oil in that part of the country, and they are priced at upwards of 20 billion each. And that was in 2013. So, with inflation, this could be at 30 billion each. Would be hugely detrimental to Petrobras's balance sheet and returns on capital. And even though we do temporarily need more refining capacity globally, when you look at the backlog of refineries being built in Asia, Middle East, and Africa, that won't last for long. There is an issue of transportation, but there isn't an issue necessarily of capacity long term.
Fascinating. Okay, let's close the conversation out today with a just quick check-in on what's happening on the gas side of the equation. Again, our colleagues at Bloomberg News had a really interesting chart the other day that showed that in 2022, the U.S. essentially caught up with Qatar and is shipped the same amount of LNG as they did last year. So we've seen a very rapid advance in U.S. LNG exports. I know a number of your companies that both of you cover are involved in that. What's your expectation when you look out into the years ahead? And is U.S. LNG going to continue to be Europe's saving grace with all of the curtailed Russian gas flows? So Will, we'll come to you first.
Yeah, I mean, it's a remarkable achievement for the U.S. I think their first U.S. LNG export cargo was only in 2016, and I think if you recall back in the early noughties, mid noughties, that a lot of these brownfield areas in the Gulf were actually designed and being constructed or completed even as regasification terminals. And this is obviously predating the fracking and the gas boom within the Permian. And yeah, of course, I mean, U.S. LNG has been an absolute savior to Europe in this energy crisis and geopolitical context. And I just think it's a bit ironic that if Vladimir Putin had decided to do what he's doing in Ukraine maybe 10 years ago, Europe would be looking at a far different energy scenario that it does right now, thanks to the advent of LNG, and the growth is going to continue. The U.S. exported 81 million tons, I think, which generally matched what Qatar did, and yeah, and the capacity growth will continue. I think Qatar is adding new trains as well in the coming years, a major expansion. Including some of Fernando and my coverage have interest in them, but yeah, the global LNG trade will continue to rise. However, it'll probably not keep up with demand. We expect a supply gap to start emerging by middle of the decade. and continue from that point on. Following on from that underinvestment in supply theme that we mentioned earlier.
Before Fernando goes, let me hop in and weigh in on your critique of predictions from the early 2000s, because I was certainly a contributor to that. I'm very fascinated by a forecast that I made in the past that we just completely whiffed on, and it wasn't just me; it was really the consensus view at the time was that U.S. gas production was in terminal decline, and there was a sense you weren't going to build any new coal plants. Renewables hadn't really arrived yet, and so how was the equation going to balance? Well, it was going to be LNG. That was sort of the magic thing that made it all fit, and it was definitely on the import bias. And so to see the exact opposite unfold is just truly fascinating. And it also, I think, it really speaks to the idea that technology and innovation can happen in the traditional side of the business, because I don't think very few people in, say, 2000 were talking about fracking or shale yet. There were a couple evangelists, but it wasn't mainstream thinking. And so it's just really interesting to see what unfolded. And basically, I agree with you. Had shale gas not unfolded in the U.S. In the way it did, Europe would look really different this winter. Okay, Fernando, enough of my thoughts.
Well, I'll just say that you weren't alone. Cheniere's Sabine Pass, as Will mentioned, was originally an import terminal that then never imported a single BTU. It became converted into the first export terminal of LNG for the U.S. And then Exxon famously bought XTO, and Henry Hub was around $10 an MBTU. So it wasn't just you that thought the end of U.S. gas was near. I think, echoing what you guys have said, we did this with Freeport being out for half the year. We are growing capacity. Cheniere still has stuff coming online. Golden Pass for Exxon is also coming in the next couple of years. And there are several other projects that are in different stages, from Tellurian to next decade, et cetera. So there's plenty of growth in the U.S. side. The question now becomes, how do we get gas to those facilities? We are running out of locations on the Texas side, where it's easier to get the supply because it's intrastate. You don't need FERC approvals, but eventually we are going to have to tap the Marcellus and Utica, the largest dry gas and wet gas plays, and those will need to go north-south towards Louisiana so we can build that export hub there. And that will require further regulatory scrutiny and ease in order for those to be built. So there is some risk on the long-term growth for LNG in the U.S. if we maintain this bias against interstate pipelines. On the Qatar side, I agree. Exxon, Conoco, Total, and Shell, I think, are all participating. It is one of the largest fields. Obviously, a lot less regulatory scrutiny. I think, my quote unquote prediction is the U.S. will surpass Qatar for a short period of time, and then Qatar will regain its crown. And then the long term, it really depends on how the energy policy that this administration or the next takes on to decide whether we want to be large exporters or if we would rather make a more radical shift towards renewable.
Okay, very interesting prediction. Let's see how that unfolds with Qatar versus the U.S. I just want to thank everyone for joining today. While we've been sitting here talking, I got a Christmas card from one of our clients who I believe is on the call. I won't name drop you, but thanks for this. And I hope everyone has a great start to their year. We're always available to talk about any of the content we've discuss here today, any of our primers on the 2,000 plus companies that we cover. We're easily found over IB, so just reach out to us, ask us questions, and otherwise we'll come back together on the third Wednesday of this month. We are certainly looking to have some additional external speakers like we did last year. So if you are interested in joining us, or you've got someone you would want to nominate, please let us know, because we're open to it. And we look forward to being in touch and hopefully continuing to be a resource for you as you think about energy markets. Take care, everyone.